so Cari, I think, is asking, my wife is American, I am Irish. If we come home to retire, we would be pulling from US retirement savings, Social Security, etc. If we put that in Irish bank, we're going to be taxed again. Oh, we only need to worry about the money earned in Ireland. Damien?
So I suppose it depends on when it's drawn down, doesn't it? Out of the US pension account. And if it's drawn down at such time when they are resident in Ireland, then it definitely needs to be looked at. It definitely needs to be looked at because I think it would be considered income. But I suppose that the way or the easy sort of what I'm thinking, the easy answer for that is if, let's say, they wanted to come to take up residence in Ireland next year, is just draw it down in this year, and that way it should be okay. They're not going to be exposed to income tax in Ireland on it next year. So again, I suppose like with the answer to I suppose a fair amount of questions such as this is just get the steps and get the timing of it right, and there shouldn't be any problem. So that would be what I'm thinking on that one.
Okay, great.
So Damien, can I just ask a follow-up? I'm sorry. So if we drew down, say, monthly after we were there, I mean, we're not going to pull all of our money out at once, right? So if we were pulling monthly or annually to support ourselves in Ireland, that would be considered income.
Yes, and Cari, in that scenario, it definitely would be liable to go on your tax return in Ireland. How that or what that would equate to in actual hard cash for you on an annual basis, like would really be dependent upon your circumstances. If there is any, I don't know, would there be any tax on it at the US end? If there was, there may be some double tax relief that you could avail of. So I suppose we'd have to look at do an estimate of what your total anticipated earnings would be in a year in Ireland, and sort of give you a bit of guidance from that, like, so you could assess how you'd feel about what the tax exposure in Ireland would be. But yeah, I'm fairly sure it would be caught in Ireland because it will be classed as income.
Okay, well, we'll give you a call, Damien, because you can bet we will be taxed when we pull it out here. So if we're over there, we'll give you a call so we can narrow that down. Thank you so much.
Like, just remember, Cari, like, could it be an option to look at? And again, it all depends on how much capital you have, or like what your fund provisioning is. But if there was enough in it, like that, you could draw down a certain percentage of it, and you were quite comfortable with what was there in the remainder. You could, I suppose, take a lump sum out in the year before you arrive or before you take up residence here and use that to fund yourselves for a couple of years. Like, that might be one way to. It all depends on what the numbers are and what what level of pension provisioning you have. So I suppose we can have a chat about that at some stage.
Great, thank you, Damien. Appreciate it.
And just to add to what Damien has said, and for people who may be in similar situations, there is, both countries recognize foreign tax credits. So in addition to which, there's a tax treaty in play. So it's very unlikely that you'd be taxed twice on the same income, because we'd be able to leverage tax credits and or the treaty itself.
Please subscribe, like, share, and comment below. Our books and upcoming events are available at htj.tax. Email us at help@htj.tax to engage us, to advise on international tax or business matters.